Hi, let's talk about Snapchat. So in case you haven't been following the market, but I doubt it because most of you are extremely avid investors. So just last week on Friday, Snapchat actually closed at $9.96 USD, and it actually experienced a 40% intraday drop. So the natural question would be, what the heck happened? Essentially, in the entire digital advertising space as well, Google was also down 5.81% and Meta was down 7.59%. So what was the trigger point? So the trigger was smashing that like button if you haven't already. Also, this video is sponsored by Weibo. So in case you didn't know, Weibo recently leveled up their game. From now until the 1st of August 2022, every single new signups can get up to $120 USD worth of Microsoft shares. I'll leave the link and instructions down below. Essentially, you just need to deposit a minimum sum of 2,000 Singapore dollars and execute a total of 6 trades in the first 30 days. So 120 USD reward for depositing 1,400 USD. That's an 8% ROI in 1 month. Definitely better than Alibaba. Jokes aside, Weibo also allows for investing into fractional shares. And I don't know why this is not a common feature for other brokerage platforms. So they pride themselves in zero commission trading as well. Don't let this 8% ROI deal get away. Link in the description. Now, getting back to the video. Essentially, Snapchat announced their earnings and it was abysmal to say the least. And more importantly, why was the entire digital advertising space affected? The market is trying to front run the idea that, hey, the entire digital ad space or all these companies that rely heavily on digital advertising will see a significant impairment in terms of both top line and bottom line earnings. So of course, you can see it as a form of foreshadowing for the rest of the companies in the same industry. And more importantly, in this upcoming week, a lot of your mama stocks or your FANG stocks are going to report earnings. So you look at Alphabet, Microsoft, Meta, Apple, Amazon. And of course, looking at Snapchat earnings, it's definitely not a rosy picture if you were to extrapolate the same sort of data for Meta and Alphabet. However, in this video, I'll just like to put forth a different case and essentially try to highlight why Snapchat is a rubbish business. And honestly, if I were to ask myself, I don't exactly know what investors of Snapchat is trying to achieve and why are they invested in this company in the first place. So also, not to overcomplicate or overanalyze things, and truth be told, I don't really understand Snapchat's business model in details, and personally, I'm also not a Snapchat user. I'm a Facebook user, I'm an Instagram user, I'm a Google user. I pretty much use most of the social media platforms out there other than Snapchat. So I really don't know why this company is still in existence. But of course, this is just based on anecdotal experiences. So if you were to look at Snapchat's second quarter earnings, financial results, their daily active user increased by 18% year on year. Their revenue increased by 13% year on year. Everything don't seem too bad if you were to look at just top line numbers and some of the key metrics in a lot of all these so-called social media platforms. However, their operating cash flow was negative $124 million and their free cash flow was negative $147 million. And you can see that, hey, why did they not put on the year-on-year percentage increase or decrease? And you will understand why later. So if I were to scroll down and to just look at the financial summary, revenue increased by 13%. Net loss, $422 million compared to $152 million. Adjusted EBITDA was $7 million compared to $117 million in the prior year. So this is a negative 94% increase. Operating cash flow, negative 124, negative 101. And that's a negative 23% increase. Free cash flow, negative 147 to negative 116. And that's a negative 27% increase. And if you were to just look at all the other numbers, it's just laughable and disgusting if I can put it that way. I don't even have adjectives to describe my feelings from here on. So on top of posting such rubbish results, common share outstanding still increased by 3%. So they are not only increasing share, they are not even producing results, and they are just spending money left and right with no regard to the common stockholder. So I don't exactly know what's the objective of this company and the board itself. So if you were to ask me personally, if you're expending so much money, if your adjusted EBITDA is down, your operating cash flow is down, your free cash flow is down, however, in exchange of that, if your revenue is growing top line by at least 40-50%, maybe that's still forgivable. However, if you look at all the different benchmark and metrics here, everything across the board is down and revenue is up by 13%. So which explains why I don't really understand why anyone is invested in this company anymore. Of course, if you were to go into the summary and the key highlights of the statement by the company, they're saying that they're investing in the augmented reality platform, and I don't know who they're trying to compete with, Meta platforms. Let's see who has made more cash to burn on this. They grew their content offering, they expanded their product and partner ecosystem. And more importantly, when I scroll through the high-level overview or summary that they're providing to investors, I don't exactly know what is their end game or how they're even intending to pull themselves out of this mess that they created. Furthermore, you can really see that there is a pure mismanagement of resources. Sure, top-line revenue is growing by a low, humble 10+%, 13% if I remember correctly, and the cost of revenue is arguably the same, where there really isn't much that you have to put in order to deliver the same sort of experience. But you can see that in terms of R&D, it ballooned, and more importantly in the sales and marketing, I think it's close to double. So the ironic thing is, they doubled their sales and marketing numbers, but revenue grew by 11-13%, give or take. Personally, I wouldn't even go near it. And one of my key criteria when I look at businesses is I need free cash flow. I want to see cash generating assets. And in this case, if my memory serves me right, Snapchat doesn't even have positive free cash flow. However, if you were to look at Snapchat's price pattern, I can understand why some people might be enticed into looking into Snapchat, because from its highs, it's down at least 88%. So just by recovering to half of the valuation of its peak at $40, it's essentially a 4x. But I think there's something very important to distinguish here. The stock price is just one part of the equation. The second part is the company. And if the company is going to produce this kind of earnings results for their investors, I only have two words: just run. However, I think the bigger concern for the broader market is what is the effect, or what kind of information and data points can we extract from this Snapchat earnings. And essentially you can see that the market is trying to front run everything, and which is why Meta and Google is also negatively impacted by this Snapchat report. So you can tell that despite Snapchat putting in so much effort in terms of sales and marketing, top line revenue is not growing as much. And many people are essentially speculating because of the recessionary pressures and how a lot of companies are cutting back their expenditure. So if you were to look at Seeking Alpha, quick plug as well, I have a link for Seeking Alpha. If you're interested, you can sign up with the link below. But looking at the earnings projection, and you can see that over the last 90 days, there was a total of 24 earnings revision for Meta platforms, and 20 to the downside, 4 to the upside. Essentially, if you were to compare the earnings expectations for Meta moving forward, we are in it for a while ride. If you were to compare to Q2 of 2021, the consensus was 3.06, and currently the consensus is 256. And just projecting out to the following 3 quarters, we are going to be down negative 19%, negative 4.48%, and negative 0.08% year on year. If you were to look back at the valuation of Meta platforms today, they are currently trading at a trailing 12-month PE of 12.81. However, the forward PE of Meta is around 14 to 15. That being said, let's assume the scenario where Meta's earnings for the coming 4 quarters is actually down 20% year on year on every single quarter. So even in that scenario, Meta's earnings is discounted by 20% for the following 4 quarters. The forward PE of Meta would be 16. And that's exactly why valuations are important when you buy into a stock. However, if you're to buy a competing company with a PE of 20, a 20% earnings revision will probably bring the PE up to 25 to 26. And that is exactly what the market is trying to discount right now and trying to essentially front run the problem. So I think these earnings estimates provided by Wall Street analysts are critically important because it gives us a sense of idea into attempting to understand what is the expectations Wall Street is trying to price in, or essentially what the market is trying to price in. I think in one of my previous video on my YouTube channel with the title "Rip Meta Stock, Institutions Dumping Facebook on Retail Investors," in that specific video, if you haven't watched it already, I do implore you to watch it. That's when Chamath, which is one of those billionaire investors out there, saying that Wall Street is doing retail investors a disservice by continuously providing such optimistic guidelines. And I think even at current consensus of negative 19%, negative 5%, negative 0% year on year, it might be still slightly on the upside, where people are still optimistic and not thinking that this upcoming or impending recession being a very huge impairment to both top line and bottom line. Now, the funny thing is, at least for myself, I'm actually looking forward to this recession. Let me try to explain. Essentially, during recessionary periods, I understand that top line demand for digital adverts or trying to expand and advertise, across the board, everybody is going to bring down their expenses. Purse strings are going to be tightened, and a lot of all the top line revenues for many of these digital adverts companies like Google and Facebook specifically will experience a downfall. However, in my Substack previously, and just a quick plug in case you haven't signed up already, link in the description as well, it's totally free, there's no paywall. In one of my specific articles where I did a deep dive on Facebook, you can actually tell that a recession, or at least in a recessionary environment, a lot of all these big dogs, which host the triopoly of digital advertising space, Facebook, Google, and Amazon, they actually tend to benefit more in the recessionary period, and I did explain my thought process here. So Meta's growth in the recessionary environment. Increasingly, there are more chatters around an impending recession. Not going to lie, I'm also in the same camp. However, I think the extent of the recession is where most investors disagree on. If you were to judge Meta's current valuation, they are trading at a PE of 12 at the time of this writing. If 2022 proves to be a really bad year, or even extending it into 2023, and earnings are cut by half, Meta's PE will be double to 24. It's simple math. So I wouldn't be too quick to judge that Meta is a must buy right now at its current valuation. However, in the grander scheme of things, recessions and economic booms are just part of a cycle. The most critical aspect of valuing the business fundamentals still relies on how accurately can you predict its future cash flows and profits. Another point I wish to bring up, the digital advertising space. So I do agree that the general spending for advertisements will decline, but as purse string tightens, frivolous and ineffective spendings are eliminated. Hence, there will be a congregation to the top dogs. It was evident in 2020 where ad revenue share decreased from 37% to 35.9% for those not in the triopoly, Google, Amazon, and Facebook. So I would not necessarily conclude that this will catalyze the death of Meta. And if you were to look at this graph, essentially in 2020 for Facebook, which is the black line, so Facebook's digital ad revenue share actually increased year on year rather than decrease. So essentially, if a heavy-handed recession is going to hit the world, I think it's going to benefit the top three, even though we can see a general decrease in expenditure. But I think those at the lower rung of the industry will essentially be eliminated. So companies like Snapchat will have the shorter end of the stick. So before I end off this video, I just wanted to jump onto one of the bear theses surrounding Facebook, which essentially say that, oh, nobody's using Facebook, it's a boomer platform, the longevity of the business is under great amount of pressure. So if you were to look at it, Snapchat has a relatively young audience profile. So just take a look at this infographic. 13 to 17 years old, around 10%, 18 to 24 years old, around 20%, and this is the bulk of their audience, which is relatively young, and they're extremely good and lucrative if Snapchat is able to grow alongside them. And then you have the 25 to 34 at 10%, 35 to 49 at around 5 to 8%. And then if you were to compare it to TikTok, you can see that it's a similar curve. It's not a bell curve, the curve is essentially tended towards the younger audience. As you can see, 10 to 19, 32%, 20 to 29, 29%. So from the age range of 10 to 30, you have at least 60% on the platform. And then if you were to compare it to Facebook, it looks more like a bell curve where majority of their audience is between 18 to 44. And more importantly, I didn't pull out the stats of Instagram, but they kind of model the same sort of curve distribution. I would just like to say this, especially for all these social media companies. There are only two main metrics you have to look at. Number one, daily active users and the number of people on your platform. Number two, its ability to generate profits. Evidently, in Snapchat's case, although despite having a very young population and being extremely popular among the kids and the teens, which explains that the longevity of the business or the longevity of the app might be arguably better than Facebook, Instagram, etc. But on both metrics, they can't grow their active users enough and their profitability is essentially down the drain. So in TikTok's case, the profitability is not there because they have yet to find an effective way to monetize, but the ability for them to grow users are at an exponential rate. So everyone is excited for TikTok. However, in Facebook's case, for both Instagram and Facebook, they managed to crack the profitability knob. They're essentially printing a lot of money. It's essentially a cash generating machine. But the main issue is many investors are essentially questioning the longevity of the business itself. So what do you think? Is Facebook and Instagram really becoming irrelevant these days? And just so you know, having a young demographic on your platform does not guarantee success. With that, I'll see you in the next video, but more importantly, I'll see you on the moon. Goodbye!